Okay, chapter 3. And remember, it really helps if you've already watched the lecture videos before you go to do the homework. Because I'm not going to spend a lot of time lecturing. I'm just going to work out the homework. All right, number 1. Pink Peony's law firm prepays for advertising in a local newspaper. On January 1st, the law firm paid $3,000 for 10 months of advertising. How much advertising expense should Pink Peony's law firm record for the 2 months ending February 28th under the cash basis? All right, so under the cash basis, it's basically all an expense when it's paid. So it would be the full $3,000 that they paid. Why does it keep going down there? All right, under the accrual basis, it's an asset. It's prepaid advertising when they pay it, and then it turns into an expense as the 10 months go by. So you basically need to do the $3,000 divided by the 10 months. So it's $300 a month. And then 2 months have gone by. January and February. So multiply that together, and your expense for January and February would be $600. All right, number 2. So it's kind of the same thing. Cash basis, but in this case it's revenue as opposed to expenses. Our Protection Home provides housing for people while they're away on vacation. Some of its customers pay immediately after the job is finished. Some customers ask that the business send them a bill. As of the end of the year, Protection Home has collected $900 from cash-paying customers. Protection Home's remaining customers owe the business $1,300. How much service revenue will Protection Home have for the year under the cash basis? So under the cash basis, it's just going to be the $900 that they've received. And under the accrual basis, it's going to be the $900 earned and received plus $1,300 earned. Because what you're looking at is how much have you actually earned. So it will be $2,200. All right, number 3. Revenue recognition principle. You recognize revenue when it's earned. Seacoast Magazine sells subscriptions for $36 for 18 issues. The company collects cash in advance and then mails out the magazines to subscribers each month. Apply the revenue recognition principle to determine A, when Seacoast Magazine should record the revenue for this transaction. All right, you record revenue as the magazines are mailed out. Not when you actually got the $36. Right, the amount of revenue Seacoast Magazine should record for 8 issues. All right, so you got $36 for 18 issues. So that's $2 per issue. So then we have 8 issues. Multiply that out, and it's $16 for 8 issues. Oops. I'm going to say $16 revenue for 8 issues. All right, number 4. Suppose on January 1st, Andrew's Tavern prepaid rent of $16,800 for the full year. At November 30th, how much rent expense should be recorded for the period January 1st through November 30th? Okay, so they paid $16,800 for the full year. So per month, it's going to be the $16,800 divided by 12. So it's $1,400 per month. And then January through November is 11 months. And multiply that out. So you should have rent expense at this point of $15,400. When you paid for it up front, it would have gone into prepaid rent. And now you're using it up. So you would have $15,400 in rent expense and only $1,400 left in prepaid rent at the end of November. All right, number 7. We have to do adjusting journal entries and T accounts. All right, open the office supplies T account in the beginning balance and purchase of office supplies. All right, I'm actually going to do that over here. And our beginning balance was $600. Right, on November 1st, Carlisle Equipment had beginning balance in the office supplies account of $600. During the month, Carlisle purchased 2,300 office supplies. And November 30th, Carlisle had 500 of office supplies on hand. Open the office supplies account in the beginning balance, did that, and the purchase. So we purchased 2,300, so that's another debit. All right, record the adjusting entry required at November 30th. So what they want us to figure out is at November 30th, we had $500 left. So that $500 is our ending balance. So we only had $500. All right, well, we currently have $2,900 in there, and it should only be $500. So you have to figure out how much you used up, and that would be on the credit side. So I'm going to do the $2,900 minus the $500. All right, so I must have used $2,400 of office supplies up to make that balance out. And they want us to do the journal entry for that. So the adjusting journal entry, I call those AJE, adjusting journal entry. We would transfer it to supplies expense, and it would be a credit to the office supplies. So it comes out of the asset account and it turns into an expense as we use it up. They also want us to do a supplies expense. So this $2,400 goes over here. We had a credit to office supplies, and it goes to the debit side of supplies expense. And that's it for that one. All right, number 8. Number 8 is depreciation. On October 1st, Orlando Gold Exchange paid cash of $57,600 for computers that are expected to remain useful for 3 years. At the end of 3 years, the value of the computers is expected to be 0. Calculate the depreciation for the month of October using straight line depreciation method. Okay, so we're going to go ahead and calculate it because it wants us to. But for test purposes, I will give you the number. We have a whole chapter later on of nothing but depreciation. And we do the calculations there. All right, so straight line depreciation is cost minus salvage divided by life. Let me fix that. That's bothering me. So salvage and residual are the same thing. Value is expected to be 0, so we don't even have to worry about it. So this is going to be 57,600 minus 0 divided by 3. So that's 19,200, but that's per year. Then we need to do 19,200 divided by 12. And that's per month. And that's what they were asking. All right, 2, record the entry. All right, the entry for depreciation expense is always a debit to depreciation expense and a credit to accumulated depreciation. And it's for the 1,600 because you're just doing it for that 1 month. Then they want us to open all the T accounts. So I have computer equipment, accumulated depreciation, and depreciation expense. I'm not putting computer equipment after each one. Alright, so computer equipment was debited for 57,600. Accumulated depreciation was credited for 1,600, and depreciation expense for 1,600 was debited. That is called posting to the accounts. And that is also their balances, so you just draw a line under it, a double line. All right, what is the computer equipment's book value at the end of October? All right, book value equals cost minus accumulated depreciation. So it's going to equal 57,600 minus 1,600. So 56,000. That was number 8. Number 9. All right, Eastside Magazine collects cash from subscribers in advance and then mails the magazines to subscribers over a 1-year period. Record the journal entry to record the original receipt of $180,000 in cash. Okay, so they got the cash up front. So they're getting cash. So you're going to have a debit to cash of $180,000. I have to have a credit of $180,000 to something. I haven't earned it yet, so it's unearned revenue or unearned subscription revenue, whichever one you want to call it. To record the adjusting entry that Eastside Magazine makes to record earning $8,000 in subscription revenue that was collected in advance. All right, so now they've earned $8,000 of this. So my liability is going down, which is a debit to the unearned revenue account for 8. And it turns into subscription revenue for 8. All right, using T accounts, post the journal entry and the adjusting entry the accounts involved and show their balances after adjustment. All right, I'm just copying these two and I will change their names. So I have unearned revenue and subscription revenue. Alright, so unearned started with $180,000 credit. And then I took 8 out of it on the debit side, and it went to the credit side of revenue. And then I'm going to go on the credit side because unearned revenue is a liability. And I'm going to say the 180 minus the 8,000. And that's its balance. And that is it for Chapter 3's homework.